There is a quiet truth about money that most people never notice. Debt doesn't destroy an economy suddenly. It weakens it slowly. Then, all at once. Every system can carry debt until it can't. And the moment that limit is reached, rules change, behavior changes, and outcomes change. People feel it as pressure, higher prices, unstable jobs, shrinking savings. Governments feel it as desperation, more borrowing to fix the problems caused by borrowing. Ask yourself this: if debt keeps growing faster than income, who is really paying the bill? And what happens when confidence breaks before the numbers do? This is not fear. This is arithmetic. One of the most misunderstood realities in finance is how risk actually forms. Most people imagine risk as something loud, a crash, a headline, a crisis. But real financial risk is quiet. It builds invisibly over years while everything appears stable. Debt is the perfect example of this. When an economy, a government, or even a household takes on debt, nothing breaks at first. In fact, life often feels easier. Growth looks stronger. Spending increases. Asset prices rise. Confidence improves. Debt gives the illusion of progress because it pulls future resources into the present. But here is the critical truth. Debt does not create risk when it is taken. It creates risk when it is normalized. As debt expands gradually, the system adapts to it. Interest payments become routine. Refinancing replaces repayment. New borrowing is used to service old obligations. None of this feels dangerous in isolation. Each step seems manageable. This is why debt grows silently. It never demands attention until it demands everything. Over time, the structure becomes fragile, not because of the size of debt alone, but because of dependency. The system begins to rely on continuous borrowing to function normally. Growth slows, but debt continues. Productivity weakens, but obligations remain fixed. At this stage, the margin for error disappears. This is where risk truly lives, in the absence of flexibility. The danger is not a single high interest rate or a single bad year. The danger is that even a small disruption, slower growth, higher rates, weaker confidence, can trigger consequences that were previously hidden. What once felt stable suddenly becomes unstable. Risk that was invisible becomes unavoidable. This is why financial crises feel sudden, even though they are not. The collapse is fast, but the cause is slow. By the time people recognize the problem, the system has already lost its ability to absorb shocks. History shows this pattern clearly. Before every major financial reset, debt levels climbed steadily while volatility remained low. Stability created complacency. Complacency encouraged leverage. Leverage magnified vulnerability. The warning signs were not chaos, they were calm. For individuals, the lesson is the same. Debt that feels manageable today can become dangerous tomorrow if income changes or conditions tighten. The risk is not in the monthly payment. It is in the lack of options when circumstances shift. Debt grows quietly because it blends into normal life. Risk appears suddenly because confidence breaks faster than numbers change. Understanding this principle matters because it shifts how you think about money. Instead of asking, "Can I afford this today?" the better question becomes, what happens if conditions change? In finance, survival is not about optimism. It is about respecting how silent risk becomes sudden realities. True financial stability is not about how large an economy looks. It is about the relationship between what is owed and what is earned. Debt can grow for a long time without causing visible damage, as long as income grows faster or at least keeps pace. The problem begins when this relationship breaks. When debt expands faster than real income, stability does not disappear immediately. Instead, it becomes artificial. At first, everything still seems normal. People are working, markets are functioning, governments are spending. The illusion of stability exists because debt hides weakness. Borrowed money fills the gap left by slowing productivity, declining wages, or inefficient systems. Growth continues, but it is no longer organic, it is financed. This is the dangerous phase. When income growth slows but debt continues, the system quietly shifts from expansion to maintenance. New borrowing is no longer used to create future value. It is used to sustain current living standards. The economy stops moving forward and starts standing still, supported by leverage. Here's the key insight. Debt that grows faster than income does not increase wealth. It increases fragility. Why? Because debt has fixed obligations while income is uncertain. Interest must be paid regardless of economic conditions. Principal must be rolled over regardless of confidence. When income fails to rise fast enough, flexibility disappears. To maintain the illusion of stability, policymakers and institutions respond in predictable ways. Interest rates are kept lower for longer, liquidity is increased, risk is pushed further into the future. These actions calm markets temporarily, but they also deepen dependence on debt. Stability becomes conditional, not real. It only exists as long as borrowing continues and confidence holds. This is why systems with excessive debt appear strongest just before they weaken. Volatility is low, optimism is high, risk premiums shrink, but underneath, the structure is tight, rigid, and vulnerable. When debt outpaces income, even small changes become dangerous. A slight rise in rates, a mild recession, or a drop in confidence can force painful adjustments. What looked like a stable system suddenly reveals itself as highly sensitive. The danger is not collapse, it is loss of control. Decisions become constrained, choices narrow. Instead of asking, what is the best long-term move? The question becomes, what prevents immediate damage? Long-term thinking is sacrificed to preserve short-term stability. For individuals, the lesson mirrors the macro reality. A lifestyle supported by growing debt but stagnant income feels comfortable until it isn't. The moment income slows or costs rise, the illusion breaks. Real stability comes from alignment. When income grows faster than obligations, resilience increases. When obligations grow faster than income, stability is only borrowed time. Understanding this principle changes how you evaluate economies, markets, and personal finances. Because true strength is not visible in size or activity. It is visible in the gap between what is earned and what is owed. Debt is not just a number on a balance sheet. It is a set of obligations that silently dictates every decision you make, whether you realize it or not. At low levels, debt is a tool. It can amplify opportunities, fund investments, and smooth timing gaps between income and expenses. But as debt grows, its character changes. It becomes a chain, not a lever. Every new obligation narrows your options. Every interest payment and principal commitment consumes resources that could have been used for growth, innovation, or security. At the national level, high debt forces governments into reactive behavior. Policy choices are dictated less by long-term strategy and more by the need to service existing obligations. Raising taxes, cutting spending, or printing money are no longer options, they become necessities. The same principle applies to companies and individuals. High leverage limits flexibility. Decisions are constrained by cash flow and obligations, not opportunity or vision. The subtle danger is psychological. People and institutions adapt to the constraints over time, normalizing the lack of freedom. They believe they are choosing, but in reality, debt is choosing for them. Investments are smaller, risks are avoided, and strategies are short-term. Innovation slows because the cost of error becomes too high. This principle explains why high-debt economies feel stagnant even during apparent growth periods. The system appears alive and functioning, but it cannot act decisively when a crisis arrives. Flexibility is the first casualty of debt, and without flexibility, even small shocks can cascade into significant problems. For individuals, the lesson is equally important. Borrowing to live beyond income may work temporarily, but it silently narrows your future. Each payment is not just a financial transaction, it's a commitment that limits the choices available tomorrow. True financial freedom is measured not by wealth alone, but by the margin of choice debt allows you to retain. The deeper truth is simple. The more you owe relative to your means, the less you control your life. Debt is invisible until it dictates your actions, and by the time you feel its weight, the freedom to act has already been reduced. In finance, control is everything. Debt does not destroy instantly, but it quietly dictates, constrains, and ultimately limits your ability to respond when circumstances change. Understanding this transforms how you view borrowing, not as a tool for more today, but as a trade-off with the freedom you may need tomorrow. At its core, money is a tool for exchange, growth, and wealth creation. But when debt dominates and borrowing is used primarily to maintain appearances rather than produce real value, money changes its role and loses its power. Think of it this way: money has influence when it flows toward productive activity, building businesses, funding innovation, improving infrastructure, creating real goods and services. In these cases, each unit of currency generates more value than it consumes. It fuels progress. Now consider what happens when debt grows faster than real economic output, and money is created mainly to cover past obligations. Banks lend to service old debt. Governments issue bonds to pay interest on previous borrowing. Companies borrow to cover operating shortfalls. Individuals borrow to sustain consumption beyond income. In all these cases, money is no longer a growth engine. It is a survival mechanism. When money is used to survive rather than to build, the consequences are subtle at first. Asset prices inflate without corresponding increases in real wealth. Financial statements look healthy, but underlying productivity stagnates. The economy appears liquid and functional, yet its capacity to generate genuine growth diminishes. Each new dollar injected produces less value than the last. Efficiency declines. Risk accumulates silently. The deeper problem is behavioral. When survival becomes the primary purpose of money, decisions shift from strategic thinking to reactive maintenance. Governments prioritize short-term stability over structural reform. Companies chase liquidity rather than innovation. Individuals chase consumption rather than savings. The system adapts to debt, not to growth. This is why economies that appear rich on paper often feel fragile in reality. Debt has turned money into a weight, not a tool. The illusion of prosperity masks growing vulnerability. Confidence becomes the only thing supporting the system, and confidence can break suddenly. The lesson for long-term thinking is clear. Money must be allowed to work for value creation, not merely survival. Real wealth is built when money flows into productive, meaningful activity, not when it circulates endlessly to service past obligations. In short, survival-driven money is powerless. It can maintain appearances temporarily, but it cannot generate growth, resilience, or freedom. Recognizing this distinction separates those who merely endure from those who truly thrive when debt pressures rise. Debt doesn't kill economies. Debt, numbers, and economic output tell part of the story. But the hidden driver is confidence. An economy, a company, or an individual can carry enormous obligations if people trust the system. Conversely, even modest debt can become dangerous if trust erodes. Think about it. A government can issue bonds worth trillions, and the markets may continue buying them without hesitation. A company can have mountains of leverage, yet investors continue lending. A household can borrow heavily, yet banks approve the loans. Why? Because confidence makes the numbers flexible. But confidence is fragile. It is not based solely on arithmetic. It is based on perception, behavior, and expectation. When confidence falters, the system reacts immediately, often violently. Suddenly, refinancing becomes difficult, credit tightens, and asset prices fall. What seemed sustainable overnight becomes precarious. This is why crises often feel sudden. The math didn't change drastically, but trust did. The invisible currency of confidence determines whether debt is manageable or catastrophic. Capacity, the raw ability to pay, cannot compensate when confidence evaporates. Debt that was once safe becomes toxic. The lesson extends to individuals and institutions alike. Even if your income covers obligations today, if lenders, investors, or counterparties lose confidence, access to funds can vanish in a moment. Cash flow problems emerge, not because the underlying numbers worsened, but because the system interprets risk differently. Confidence also affects behavior long before failure occurs. Anticipating loss of trust, governments, companies, and individuals take preemptive measures. They cut spending, raise interest rates, or hoard liquidity. Markets react. Economic growth slows. Debt that once seemed benign now shapes every decision. Here's the principle. Stability is not measured by resources alone. It is measured by perception. Debt does not exist in a vacuum. It exists in a network of trust, expectation, and willingness to act. Without confidence, even the strongest balance sheet can unravel. For anyone navigating debt or financial risk, the insight is crucial. Always consider not just what can be paid, but what the system believes can be paid. Confidence amplifies or undermines capacity. In the end, money and debt are tools, but trust is the lubricant that allows them to work. When confidence disappears, leverage turns from opportunity into constraint, and the system becomes fragile. Summary thought: debt is only as safe as the belief in its sustainability. Numbers provide capacity, but confidence provides survival. Economic history is a story of repeating patterns: boom, debt accumulation, confidence, apparent stability, and then a turning point. Every financial cycle, whether it lasts decades or years, ends in one of two ways: adjustment or reset. Adjustment is gradual. It occurs when policymakers, institutions, or individuals recognize that debt has reached unsustainable levels before it triggers a crisis. Interest rates rise moderately, spending slows, leverage is reduced, and confidence is managed carefully. In this scenario, pain is distributed over time. The system contracts, corrects, and eventually stabilizes without total collapse. Markets wobble, growth slows, and some actors fail, but the overall structure survives. This is the preferred outcome because it preserves flexibility and allows strategic decisions to remain possible. Reset, on the other hand, is sudden and often painful. It happens when debt reaches a tipping point that cannot be contained by incremental adjustments. Confidence breaks faster than numbers change. Credit dries up. Asset prices crash. Governments and institutions scramble to respond, often with emergency measures, bailouts, or aggressive monetary expansion. The system essentially wipes the slate clean, forcing everyone to absorb losses and rethink their assumptions. Reset is inevitable when debt outpaces capacity for too long and trust erodes. The principle behind both outcomes is simple. Debt is a structural stress. It accumulates silently, often unnoticed, until it reaches a level where the system can no longer function normally without intervention. The larger the imbalance, the harsher the required correction. Nature doesn't allow endless overextension, and economies are no exception. Cycles are not moral judgments. They are arithmetic and human behavior combined. Debt fuels growth during expansion, but when limits are reached, the same debt magnifies vulnerability. What appears as opportunity in the good times becomes constraint in the bad. Understanding this pattern allows individuals and institutions to anticipate risks instead of being surprised by them. For investors, leaders, and households, the lesson is clear. Preparation is the difference between surviving adjustment and being crushed by reset. Preserve flexibility, maintain liquidity, and avoid overextending commitments. Those who act only when the crisis arrives often face the harshest outcomes because by then, choice has already been lost. The deeper truth is timeless. No matter how advanced an economy, how wealthy a company, or how successful an individual appears, debt cycles govern outcomes. Ignoring them is dangerous. Respecting them allows resilience. This is not a prediction. It's a pattern repeated across time. When debt reaches its limit, speed no longer helps. Only structure does. The future will not reward those who chase returns. It will reward those who understand risk, preserve flexibility, and think long-term. Because in the end, wealth is not about how much you earn. It's about how well you survive when the system changes.